Suresh Soni is the CEO of BNP Paribas Mutual Fund, now joining in on the show to walk us through a little bit of direction. Thank you so much for taking time out. Suresh, to begin with, given that we're at the fag end of the earnings season, we've had the Fitch downgrade as well that came in for US equities. What's your outlook as to what the next key trigger point could be for the markets?
The markets have been on a good wicket because India's macro story has remained fairly strong, both on stability dimension as well as on the growth dimension. Our fiscal deficit has been pretty good because of the GST collections. Forex situation is fairly strong, and our inflation has remained under control. And at the same time, if you look at the impulse for growth, whether it is our GST collection, PMI numbers, or the growth so far in the earnings reported by the companies, all of that has been on a fairly strong wicket. So that has given a strong background to the market. And based on that, the overall macroeconomic outlook looks fairly strong. And the equity markets are also drawing a comfort from that.
Okay, just let's nail it down then to individual sectors as well. What's the outlook when it comes to the entire financial space? Do you believe that, the compounding story when it comes to large cap banking names will continue to remain intact?
Banking is a space that we really like. The country is witnessing a fairly strong credit growth after a long period of time. Our credit growth is between 15% thereabout, which is the highest in the last decade. Bank balance sheets are clean. Over a period of time, the banks have really been able to balance themselves quite well. So bank NIM margin, balance sheet holding, as well as their credit quality and credit growth is all looking fairly good. So we believe that this is a segment which will see accelerated earning growth. The large players will probably do disproportionately better within the banking. But aside from banks itself, we also like select NBFCs because there we see a disproportionate impact of large credit growth coming in, and therefore the earnings cycle being fairly robust.
All right. Do you believe that, there is a lot of potential within the entire manufacturing space? Can you walk us through some stocks that you would be bullish on within the entire capital goods space, the Make in India theme working well for the space?
Sure. So if I were to really tell you the broad segment of the market that we are focused on, in fact, we are focused on 3 C's, that is capex, credit, as well as consumer. So I spoke about credit just a moment back, but coming to capex, we believe that what is happening in India is over a period of time, we have not added significant capacity. And right now, the industrial capacity utilization is close to about 75%. The balance sheet of the corporates are in a fairly good space. So when you see good earning momentum, when you see the balance sheets in a good shape, as well as capacity utilization around 75%, we see industrial capex picking up. And we already have a strong capex running from government, which is basically in the form of infrastructure spending. Added to that, you have a PLI scheme, which has helped, as well as China Plus One. So capex is a fairly strong theme, which is emerging. And we believe that this is fairly long room to go. And there are enough play within the capex sector that will be focused on. Another theme, of course, that we have not spoken about thus far, which we like, is consumer. Post-COVID, there was one period of time when we were talking about K-shaped recovery, and therefore slightly lack of confidence in the rural consumption. That has improved now. So while the long-term story in consumer remains fairly strong, there were some near-term concerns that we had in between, but that seems to be easing out a little bit. So consumer story again looks pretty good based on the fact that rural demand is kind of coming back. There is some amount of premiumization that we are seeing, as well as this is a segment which has got fairly good long-term potential. So this is another segment that we like.
All right. But, having said that, when it comes to the consumption space, at least when we look at the kind of earnings that have been delivered by a lot of the FMCG or consumption companies, the slowdown is pretty evident when it comes to volume growth. So what's driving that confidence?
So as I told you, that there was indeed a period of time when the volume growth did suffer. That was post-COVID, as well as some amount of input cost rise last year that could not be passed on to the consumer. But we are seeing that turning back now. So going forward, we believe the setup is relatively better for this sector.
Okay. So are there any sectors of the market right now that you believe that one should be completely avoiding at the current juncture?
So the way we are going about it, to be fair, is that we are focused a lot more on the domestic-oriented sector. We believe that even if you were to look at the earning growth thus far, the disappointment have been generally from the global-facing sectors like IT, metal, oil, and gas. Whereas the domestic-oriented sectors, whether it is your auto or industrials, they have done really well. So given the fact that domestic economy tends to be in a relatively strong space compared to what is happening around the globe, being overweight on the domestic segment is a very clear preference that we have, and that's what we'll advise to the investors as well.
Okay. What's the outlook then when it comes to the entire, broader market spectrum? How do you believe investors here should be picking and choosing, for opportunity here? What should be the criteria it is that you look at?
Sure. You know, at these kind of markets, when we have seen indices touching new highs recently, there can always be some amount of nervousness in investors that, am I too late? Has the market run up too much, or will I make money if I invest now? Our belief is absolute levels are important, but what matters more is the valuations of the market. If you look at the market valuations, I think with a combination of strong macro earning growth as well as domestic and FI flows, we have seen markets now moving slightly above the long-term averages. However, the earning growth now still remains mid-teens, and therefore it's not that markets are extremely expensive or frothy. They are slightly above long-term averages, but at the same time, for our medium-term investors, there should not be a worry in terms of investing into the market. We believe the foreign flows have just started in India. I think in the last 3-4 months, we have seen about 125, 150,000 crores of foreign flows, which is more than the entire outflow that we had in the last year from FIs. As Indian growth story remains strong, we believe that foreigners who are relatively under-owned in India might invest more money. Domestic flows have remained strong. The investors have been putting money month after month in SIPs. I continue to see that trend. So overall, from a flow perspective, markets seem to be reasonably well placed as well.
All right, appreciate your time. Thanks very much, Suresh, for joining in and sharing with us your outlook on the markets.